On August 5th, 2024, at exactly 9:31 a.m. Eastern Time, the U.S. stock market opened, and within seconds, it was clear something was very wrong. In the first minute of trading, the S&P 500 dropped 1.3%, not slowly, not over hours, instantly. Before most traders had taken their first sip of coffee, roughly $300 billion in market value had disappeared. By 9:45 a.m., the index was down 2.7%. By 10 a.m., it was off 3.1%. This wasn't normal profit-taking. It wasn't routine volatility. It was forced, indiscriminate liquidation. And the cause had nothing to do with U.S. earnings, American companies, or the domestic economy. The trigger was nearly 7,000 miles away in Tokyo, where 4 days earlier the Bank of Japan had done something it hadn't done in 17 years. It raised interest rates. Welcome to Economy Meet History, where we connect the financial shocks reshaping your portfolio to the long-term patterns that have governed markets for generations. What I'm about to walk you through isn't speculation. It's documented history from just 6 months ago, history that 95% of investors still don't fully understand. More importantly, the same forces that caused the August 5th crash, the largest single-day percentage drop in the S&P 500 since June 2020, are still in motion. In fact, they're intensifying. Once you see how a policy decision made in a conference room in Tokyo can ripple all the way into your retirement account, you'll understand why the next 6 months could determine whether you preserve your wealth or watch part of it evaporate. Before we break down the trillion-dollar mechanism almost nobody is paying attention to, do something important. Subscribe and turn on notifications. This isn't a one-off event. It's a structural shift unfolding in real time. Mainstream financial media covered August 5th for 48 hours and moved on. They're missing the bigger story. And comment below how much of your portfolio is currently in U.S. stocks. By the end of this, you may rethink that allocation. If this analysis sheds light on something your financial advisor never explained, hit the like button so others can see it before it's too late. Let's rewind to July 31st, 2024. The Bank of Japan, Japan's central bank, held a policy meeting. For 8 straight years, Japanese interest rates had been negative. Negative. You could borrow money in Japan and effectively get paid to do it. This wasn't an error. It was deliberate policy to fight deflation and stimulate growth. On July 31st, they raised their benchmark rate from 0.1% to 0.25%. A tiny move, just 15 basis points. Under normal conditions, that would barely make headlines. But these were not normal conditions. That small increase triggered the unwinding of what's estimated to have been a $20 trillion carry trade. $20 trillion, larger than the entire U.S. economy. And when that much leveraged capital begins to unwind, markets don't gently adjust. They snap. Here's how it works. For decades, hedge funds and institutional investors borrowed in currencies with extremely low interest rates, like the Japanese yen, and invested that money in higher-yielding assets elsewhere, such as U.S. stocks or bonds. The profit was the spread between borrowing costs and investment returns. With Japan's near-zero or negative rates, it was the perfect funding currency. Imagine borrowing 100 million yen, converting it into dollars, and buying U.S. assets yielding 4% or 5%. If your borrowing cost was effectively zero, you pocketed the difference. It was a beautiful trade, until it wasn't. The vulnerability? Currency risk. The strategy only works if the yen remains weak or stable. If the yen strengthens, repaying that yen-denominated loan becomes more expensive in dollar terms. For example, in January 2024, $1 bought $150 yen. Borrow 15 million yen, and you'd need about $100,000 to repay it. But after the Bank of Japan's rate hike, the yen strengthened. By August, $1 bought 140 yen. Now repaying that same 15 million yen required roughly $107,000. That's a $7,000 loss purely from currency movement, before accounting for what happened to your investments. Now multiply that across thousands of leveraged funds. When the yen strengthened, positions started bleeding. With leverage involved, losses trigger margin calls. Brokers demand more collateral immediately, or they liquidate your positions. Most couldn't add cash fast enough, so the selling began. Because Tokyo opens before New York, the shock hit Asia first. On Monday, August 5th, the Nikkei 225 plunged 12.4% in a single session, its worst drop since 1987. But the carry trade wasn't limited to Japanese stocks. It touched U.S. equities, bonds, Europe, emerging markets, everywhere. When margin calls hit, investors sold whatever they could, regardless of quality. By the time U.S. markets opened, S&P futures were already down 3%. The Dow fell 1,000 points in the first hour. The Nasdaq dropped 500. The VIX, the fear index, spiked to 65. For context, normal is around 15. During the COVID panic in 2020, it peaked at 82. A reading of 65 signaled extreme fear. What made August 5th unique? There was no negative economic news. Earnings were solid. Unemployment was low. GDP was growing. This wasn't fundamentals. It was structural deleveraging. Fast forward to today. Markets recovered. The S&P 500 is near all-time highs as of February 2025. So why does this still matter? Because the Bank of Japan isn't finished. On December 19, 2024, they raised rates again from 0.25% to 0.5%. Governor Kazuo Ueda has signaled more hikes could come if wages keep rising. Markets expect another increase soon. Every rate hike strengthens the yen. Every stronger yen pressures the carry trade, and every unwind risks renewed selling. According to the Bank for International Settlements, the yen carry trade still totals roughly $15 trillion. Even if just 10% unwinds quickly, that's $1.5 trillion in potential forced selling. That's nearly half the market cap of Apple, enough to shake global markets. Now layer in China. China is the second largest foreign holder of U.S. Treasuries. As of late 2024, it held about $772 billion, down from $816 billion months earlier and far below its 2013 peak of $1.3 trillion. China has been steadily reducing exposure for years. Why? Diversification, geopolitical risk, and domestic economic pressures. After Western nations froze $300 billion of Russian reserves in 2022, every central bank took notice. China has increased gold purchases, invested in commodities, and reduced reliance on dollar assets. It's also using reserves to stabilize its own economy and currency. Meanwhile, the U.S. runs a roughly $2 trillion annual deficit. That means issuing $2 trillion in new treasuries each year. If major foreign buyers like Japan and China step back, yields rise. The 10-year Treasury yield sits around 4.3%, up sharply from 1.5% in 2021. Higher yields mean higher mortgage rates, corporate borrowing costs, and credit card interest. They also compress stock valuations because future earnings are discounted at higher rates. If discount rates rise from 4% to 5%, valuations fall, even if earnings don't change. Multiply that across a $45 trillion equity market, and you see the pressure. The Federal Reserve controls short-term rates, but long-term yields depend on supply and demand. If foreign demand weakens, yields rise whether the Fed wants them to or not. Now imagine this scenario. Japan hikes again. The yen strengthens further. Carry trades unwind. At the same time, China continues trimming treasuries. Yields climb toward 5%. The S&P falls 5%, then 10%. Volatility spikes. Margin calls spread. Retail investors panic. The Fed faces a dilemma. Cut rates and risk inflation, or hold steady and risk deeper declines. I'm not predicting disaster. Markets are resilient, but the vulnerability is structural. So what should you do? First, examine interest rate risk, especially long-duration bonds. Rising yields can crush their prices. Consider shorter duration or floating rate exposure. Second, review rate-sensitive equity sectors like REITs and utilities. Higher yields make them less attractive relative to treasuries. Third, diversify internationally. Different regions are on different monetary paths. Fourth, hold cash. Cash provides flexibility when forced selling creates opportunity. Fifth, consider a modest gold allocation, 5% to 10% as insurance. Gold carries no counterparty risk and can hedge against systemic stress. Psychologically, understand the difference between forced liquidation and fundamental repricing. Forced selling creates sharp, high-volume, chaotic declines, often buying opportunities. Fundamental repricing is slower and steadier. Zooming out, we're witnessing a broader transition. For decades, the U.S. sat at the center of the global financial system. But as Japan normalizes policy and China diversifies reserves, capital flows are shifting. These transitions historically are messy. The next decade may not resemble the last. Rates may remain structurally higher. Valuations may compress. Diversification may matter more than ever. I'm not telling you to sell everything. I'm telling you to understand the mechanism. Decisions made in Tokyo or Beijing can impact your portfolio in ways unrelated to company earnings. Reduce leverage, diversify, hold some cash, consider hedges, and mentally prepare for volatility. Decide now how you'll react to the next shock, because in the moment, emotion takes over. This is Economy Meet History, where we separate signal from noise and connect today's headlines to long-term patterns. The margin call already happened once. The forces behind it are still building. The question isn't whether volatility will return. The question is whether you'll be ready when it does. I'll see you in the next one.